Good morning, and welcome to TOITOI Japan Market Radio for December 6, 2025. I'm your host coming to you from Tokyo, and this is your daily briefing designed for global investors tracking Japan's equity, currency, and rates markets. Joining me today is our portfolio manager who specializes in Japanese macro and equity positioning. Let's dive straight into today's session.
Thanks for having me. Before we get into the news flow, I should mention that Japanese markets were actually closed today for a holiday, so we don't have fresh equity or bond data to report. That said, there's been significant macro developments overnight and over the past 24 hours that are highly relevant for anyone with Japan exposure, particularly around the US dollar, Federal Reserve expectations, and some notable portfolio moves by foreign institutions. So even without domestic trading, there's plenty to unpack for positioning into next week.
Absolutely, and let's start with the currency angle because that's been front and center. The headline crossing wires earlier today was about the US dollar slipping as traders position ahead of next week's Federal Reserve meeting. This is clearly a key risk event for anyone invested in Japan. Can you walk us through what's happening and why it matters specifically for Japanese assets?
Sure. What we're seeing is the dollar weakening across the board as market participants reassess the Fed's policy trajectory heading into next week's decision. There's growing speculation that the Fed might signal a more dovish stance, or at least provide clarity on the pace of future rate adjustments. For Japan, this matters enormously because the interest rate differential between the US and Japan has been one of the dominant drivers of yen weakness over the past year. If the Fed pivots toward a slower tightening path or even hints at eventual rate cuts, that differential narrows, and we could see significant yen appreciation.
And that yen strength would have mixed implications for Japanese equities, correct?
Exactly. It's a classic two-sided story. On one hand, a weaker dollar typically benefits Japanese exporters in terms of competitiveness, think autos, electronics, machinery, because their products become relatively cheaper in global markets. On the other hand, yen appreciation is a headwind for those same companies when they repatriate overseas earnings. For the Nikkei 225 and TOPIX, which are heavily weighted toward exporters, the net effect really depends on the magnitude and speed of any yen move. A gradual dollar decline might be manageable, but a sharp unwind of carry trades could cap equity gains or even trigger profit-taking. Domestic-focused names, meanwhile, tend to suffer more directly from yen strength because they lack the foreign revenue offset.
And on the rate side, what should we be watching in terms of Japanese government bonds?
If the Fed does turn dovish, we'd likely see safe haven flows into JGBs, which would support bond prices and keep yields stable or push them lower. The US-Japan yield spread is critical here. Any compression in that spread reduces the carry attractiveness of holding dollar assets versus yen assets. That could bring some foreign capital back into JGBs, though the Bank of Japan's own policy stance will also matter. For now, the baseline expectation is that JGB yields remain anchored, but Fed signals next week could shift that calculus quickly.
So the Fed dot plots and forward guidance are really the key monitoring points for Japan investors next week. Staying with the Fed theme, there's actually another layer to this story that's worth discussing. We're hearing reports about internal divisions within the Federal Reserve itself, with some committee members potentially dissenting on the policy path. This introduces a new element of uncertainty. How does that play into your Japan positioning?
It's a great question, and frankly, it adds a layer of volatility that markets don't love. When the Fed's policy committee is visibly split, it signals that even the Fed itself isn't confident about the right course of action. That uncertainty tends to reduce global risk appetite in the near term, which is generally a headwind for equities, including Japanese stocks. Investors pull back from risk assets and rotate toward defensives or safe havens. For the Nikkei and TOPIX, that could mean short-term pressure, especially on cyclical and export-heavy names.
But there's a flip side if the Fed ultimately leans dovish despite the internal split, right?
Correct. If the dovish camp wins out and Powell signals a slower pace of tightening or even a pause, that would be a net positive for Japanese exporters because it would likely weaken the dollar and ease financial conditions globally. The yen would strengthen, but as we discussed, that's a mixed bag. Conversely, if the Fed remains hawkish despite the internal disagreement, we could see the yen weaken further, which would be supportive for export-driven equity valuations in the near term. The bottom line is that Powell's messaging and the committee's forward guidance will be critical for anyone managing Japan exposure. We're essentially in a holding pattern until we get that clarity.
So it's very much a wait-and-see moment. Meanwhile, shifting to corporate news and institutional flows, there was an interesting development involving Mitsubishi UFJ Financial Group. Capital Fund Management, a European asset manager, has cut its stake in MUFG. This caught my attention because MUFG is such a bellwether name for foreign investors in Japan. What do you make of this move?
It's definitely worth noting. MUFG is Japan's largest bank by market cap and a core holding for many global asset allocators. When a significant foreign institution like Capital Fund Management reduces its position, it can signal a few things. It could be straightforward profit-taking after a strong run, or it could indicate a broader shift in sentiment toward Japanese financials or even Japanese assets in general. The banking sector in Japan is particularly sensitive to interest rate dynamics, both domestically and in the US, so this could also reflect a view on the Bank of Japan's normalization path or concerns about the sustainability of the carry trade.
And in terms of immediate market impact, what should investors be watching?
In the near term, this could put modest pressure on Japanese bank stocks and the broader financial sector within TOPIX, simply because MUFG is so heavily weighted. But the real question is whether this is an isolated move or part of a larger pattern of foreign divestment. If we start seeing more foreign funds trimming Japanese bank exposure, that could suggest a reassessment of the sector's outlook, possibly tied to concerns about yen strength hurting net interest margins or doubts about the BOJ's ability to continue normalizing rates. On the yen side, the direct impact is probably minimal unless this is part of a broader capital outflow trend. For JGB yields, there's no immediate connection, but it's worth monitoring whether foreign portfolio adjustments start showing up in broader flow data.
So the key is to watch whether this is a one-off or the start of a broader repositioning by foreign institutions. That makes sense. Let me bring us back to the bigger picture here. We've talked about dollar weakness, Fed uncertainty, and some notable portfolio moves in Japanese financials. For a global investor sitting in New York or London with Japan exposure, what are the main themes to carry forward into next week?
I'd say there are three key themes. First, the Fed meeting is the dominant risk event, and it will drive near-term moves in USD, JPY, and by extension Japanese equities. Watch the dot plots and Powell's press conference closely for any shift in tone. Second, yen volatility is likely to remain elevated, and that means Japanese exporters could see increased earnings uncertainty. If you're overweight export-heavy sectors, you need to be prepared for potential currency headwinds. Third, keep an eye on foreign institutional flows into Japanese assets, particularly financials. The MUFG stake reduction might be an early signal of a shift, and if more foreign managers follow suit, that could have broader implications for market sentiment and valuation support.
All very actionable points. And of course, with Japanese markets closed today, we'll get fresh data next week that will give us a clearer picture of how investors are positioning. Before we wrap, any final thoughts on what global investors should be prioritizing as they think about Japan exposure heading into year-end?
I think the key is to stay nimble and avoid making big directional bets until we have more clarity from the Fed. The macro crosscurrents are complicated right now. You've got Fed uncertainty, BOJ normalization still in its early stages, and seasonal year-end flows that can amplify moves in either direction. For equity investors, it might make sense to balance exposure between exporters and domestic plays, rather than being overly concentrated in one direction. On the currency side, consider hedging strategies if you're sensitive to yen moves. And on rates, JGBs remain a safe haven play, but the carry dynamics could shift quickly depending on what the Fed does. Bottom line: stay informed, stay flexible, and don't get caught leaning too hard one way.
Solid advice. That's a comprehensive look at the key drivers for Japan markets as we head into a critical week. If you're a global investor tracking Japan or managing exposure to Japanese equities, FX, or rates, I hope today's discussion gave you some useful context and themes to monitor. Consider subscribing to TOITOI Japan Market Radio if you want to stay on top of these daily developments. Thanks to our portfolio manager for the insights today, and we'll be back next week with fresh market data and analysis. Until then, stay informed and trade carefully.